let's go into on face value what people say about the stock market, bonds, and rental properties. My opinion is if you talk to people on the streets and you ask them what's a better investment, people will largely say, well, listen, I'm going to make more money in the stock market than in bonds. They may say that in real estate, you can make a lot of money, but it's not an overwhelming win. And they would basically say, well, I'm probably going to make about the same amount of money in the stock market as I would in owning real estate or in rental properties, at least passively. And they'll say, well, it's just not worth the headache. So I'm just going to stick to the stock market because it's easier and there's not enough of an advantage for me to learn something different. Do you feel like that's maybe just a summation of how an average investor would think?
Yeah, totally, man. When I talk to my friends about this thing that I'm doing, at least when I first started talking to them, before I really knew it, it was just like, man, it's too hard to do it the other way. This stuff, I can just kind of like cover my eyes. I know I'm going to get like 7 to 8% long-term, let that thing compound, right? It's just kind of taking the simple route, right?
Yeah. And I think for somebody to move from maybe the average way of doing it, you would either have to see a huge benefit, maybe make a lot more money, or you would have to see that it would be so much easier than what you were expecting in rental properties. And somewhere along the line, the average investor out there does not see either of those. And so that's why they continue to do the same thing, even though we know that the stock market is incredibly volatile. And if you are, it doesn't always happen when you're 77 like your dad, but you generally have a bear market happen, call it once a decade or less than that, right? So if you are in your 50s and 60s and 70s, you are going to deal with volatility and pain. And so what is really interesting is people say, that's okay. I'm going to deal with that when it gets there. I'm going to keep putting my money in the stock market. So what I wanted to do is let's go back and let's see if you made that same decision 20 years ago. Now that we have the benefit of hindsight and we see how this has actually played out, you had the decision to invest in the stock market, and you just bought a share of the S&P 500 index, or you invested in a bond, and I chose the US Treasury, 30-year US Treasury bond, or you had the option to invest in a rental property in Jacksonville, Florida. This is what you would have seen on the surface. All right. So for the stock market, and I'm being I'm trying to give everything I can to the other asset classes, and I'm trying to take away as much as I can from the rental property investment to prove a point here. Generally, if you look in the stock, in the S&P 500, your dividend is somewhere between maybe 1.5% to 2%. And so I said, okay, 20 years ago, your dividend would have been about 2%. That means for the amount of money that you put into the stock market, into the S&P 500, you would get about 2% of that each year as income to you. That's your dividend. All right.
Mm-hmm.
If you keep going down the line, I also went and I looked at asset appreciation. So in the stock market, how much did the S&P 500 go up in the last 20 years? This is great. We can see the data. And if you look year over year, on average, the stock market went up 7.6% per year. All right. Then let's take a look at bonds. So if I actually went back and I looked at the 30-year US Treasury in 2002, and that was paying a 5% coupon, which is the same thing as yield, dividend, positive cash flow. It's all the same stuff in essence, right? It's money that's coming to you. So you would have earned 5% per year if you bought that bond. Now, the way bonds work is if you hold them to maturity, right, you get your original principal back. You made all that money in the coupon or the cash flow along the way, but you don't get asset appreciation in a bond. You just get all of your principal back later on. So if you look at asset price appreciation over those 20 years, you don't have asset price appreciation. You held it to maturity, right?
Yep.
And then if you look at rental properties, so I actually went back and I did the research here for the Jacksonville market. And I just assumed that you got 0% positive cash flow, like 0% cash on cash return. That's a term that people use to evaluate how much money you receive in positive cash flow for a rental property and for other assets, but for rental properties, it's used. And let's just assume that this is break even. You're not getting any positive cash flow from this investment. It's 0% cash on cash, right?
Mm-hmm.
And then I looked at what the asset price appreciation is for the Jacksonville real estate market from 2002 to 2022. It appreciated 5.2% per year That's real numbers.
Wow.
So Pablo, when you're looking at this, what do you think the best investment is? What do you think the worst investment? Like, what's the clear winner here?
When I'm looking at this, just as a layman looking at these numbers, the stocks of 2% with asset price appreciation of 7.6% looks pretty good.
Yeah, absolutely.
Yeah.
That's the clear winner,
Yeah.
right?
Yeah.
Now, bonds, you would say, the bond investor would say, income is more important to me and preservation of capital. So you would say for a certain section of the population that bonds would play a role. And so the typical portfolio, the way that most standard financial advisors build a portfolio of stocks and bonds, is they typically put 60% of the capital into stocks and 40% into bonds. And then over time, they switch that maybe to 60% bonds, 40% stocks, or maybe getting to 80-20, but that's how they allocate this, and they keep it within that sphere. Rental properties don't look very attractive here, do they?
No, doesn't look that attractive.
So we can understand why average investors, the people you talk to on the street here, keep their money in the stock market and in bonds and don't see the big advantages that come from owning a rental property. It's pretty clear here.
Yep. Yeah. Totally, man. So what are we? Okay. I look at this and I see that this is the average view, right? This screams to me the normal conversation that I get in, and the reason why people are like, yeah, man, why would I do this? You know?
Yeah. So let's take a look. Let's dive a little bit deeper, because this on the surface is exactly what people are thinking, but there's so much missed. And that's what we're going to dive into right now.
Let's dive in.
So what I did next was I actually broke down each of the profit centers. And of course, when we're talking about dividend or yield or cash on cash return, that's only one of the profit centers. When we're talking about asset price appreciation, that's another profit center, right? But in rental property investing, there's actually 5 profit centers, of which I only put 4 on here for simplicity's sake. But I actually broke it down. There's so much hidden benefits when it comes to owning rental properties. And we're going to compare this asset to asset if you had invested in each one of these 20 years ago. And let's just say that you had $35,000 to invest 20 years ago. How would this have turned out? And these numbers are staggering. For those who are watching live right now, you're seeing some large numbers and you're seeing the punchline even before I get to it. But we're going to break it down, right?
Yep.
On the stock side, you would have seen positive cash flow or dividend of $14,000, which is really nice. We like that. That's that 2% dividend. You would not have seen any tax savings. You would not have seen any principal pay down, and you would have seen asset price appreciation minus any selling costs of about $116,000 for a total return on investment of about $130,000. Sounds pretty great, huh, Pablo?
Sounds pretty good, man.
Let's compare that to the bonds, right? If you invested in a 30-year US Treasury and you bought that 20 years ago, you would have received $35,000 in cash flow. There's your 5% coupon. You don't get any extra tax savings from that. You don't have any principal pay down from that, and you don't have any asset price appreciation. So your total return on investment would be $35,000.
Doesn't look as good.
Doesn't look as good. You do that if you want to be conservative and if you value income, and quite honestly, you don't have any other better options. You're not a part of a community like this. Now, Pablo, let's take a look at that last line item right there, brother.
It's looking juicy, man. It's looking juicy. Talk me through this line item.
Well, let's first start with positive cash flow, right? I just said day one, you had $0. You had a 0% cash on cash return. It was break even when you bought that rental property. How do you have $31,909 in positive cash flow from the same property you bought 20 years ago?
Say it again. My engaging in 2 conversations caught up to me. I'm sorry.
So day one, right? Go back to that slide that we had previously. So day one for Jack's rental property investment, it says 0% cash on cash. That's the same thing as saying there's a $0 positive cash flow coming from this rental property. The rent that you make on that is gobbled up by the expenses that you have on it, and it's break even.
Got it. Okay, now I know. So how do we get to this much positive cash flow?
Yeah.
Increased rents.
There you go. There you go. It's not just increased rents, right? It's increased rents, and one of your biggest expenses stays the same. What's the biggest expense that stays the same?
Your mortgage.
Your mortgage. So your income is going up, and I chose 3.3% per year. because that's the historical average in Jacksonville. But one of your biggest expenses is staying flat. Huge value there. Now, your other expenses are going up as well, right? You've got property taxes, property insurance costs, maintenance costs, things of that nature. We assumed all of those went up 3%. And you can see all these assumptions labeled below. But the big thing here is cash flow immediately does not tell the final story for rental properties. And that's why I sing this from the rooftops and I tell people, stop paying so much attention to day one cash flow.